Right now, something massive is happening behind the scenes of the global financial system, and almost no one is talking about it, because China just walked away from hundreds of billions of dollars in US debt, not quietly, not gradually, but at a scale so large it shocked bond markets and raised a dangerous question: why would the world's second largest economy accept record losses just to get out? This is the story of the $688 billion exit, and why it may signal a turning point for the dollar, global power, and your money. To understand why this matters, we need to step back and look at how China and the United States became so financially intertwined in the first place, because for decades this relationship looked almost unbreakable. After China joined the World Trade Organization in 2001, its export machine exploded. Chinese factories produced everything from electronics to furniture, and Americans bought it all. Those dollars didn't just sit in Beijing vaults. China recycled them back into the US by buying treasury bonds, essentially lending America its own money. This served both sides. The US got cheap financing to fund government spending and keep interest rates low. China got a stable place to park its reserves while keeping its currency weak, which made exports even more competitive. For years, this symbiosis was described as mutually assured prosperity. But beneath the surface, cracks were already forming. US Treasuries are often described as the safest asset in the world. They are backed by the full faith and credit of the US government, deeply liquid and historically reliable. But safe does not mean risk-free. Bond prices move inversely to interest rates, and when rates rise, existing bonds lose value. That basic rule of bond math is crucial here. When the Federal Reserve began aggressively raising interest rates to fight inflation after 2021, the market value of previously issued low-yield treasuries fell sharply. Any large holder who sold during this period would almost certainly lock in losses. China knew this, and yet it sold anyway. By 2013, China's US Treasury holdings peaked at around $1.3 trillion, making it America's largest foreign creditor. Fast forward to today, and that number has collapsed to roughly $688 billion. That means China has unloaded more than half its position. What makes this exit extraordinary is not just the size, but the timing. Much of the selling occurred during one of the worst bond bear markets in modern history. Yields on the 10-year Treasury surged from under 1% to over 4% at their peak, crushing bond prices. Analysts estimate China absorbed tens of billions in unrealized and realized losses during this drawdown. So the obvious question is, why would China choose to sell at such a painful moment? One explanation is simple risk management. China holds more than $3 trillion in foreign exchange reserves. Keeping such a large share in one country's debt exposes it to political, financial, and currency risks. Over the last decade, relations between Washington and Beijing have deteriorated dramatically. Trade wars, sanctions, technology bans, and geopolitical flashpoints like Taiwan have transformed economic interdependence into strategic vulnerability. From Beijing's perspective, holding vast amounts of US debt increasingly looks like keeping your savings in the bank of a rival who openly discusses cutting you off. Even if treasuries are technically safe, access to them might not be guaranteed in a severe geopolitical crisis. Another factor is currency strategy. China has long sought to internationalize the yuan and reduce dependence on the US dollar-dominated system. Selling treasuries and reallocating reserves into gold, other currencies, or strategic assets supports that goal. Over the past several years, the People's Bank of China has been one of the most aggressive buyers of gold in the world. Gold is no one else's liability. It cannot be frozen, sanctioned, or defaulted on. For a country concerned about financial sovereignty, that matters. While gold does not pay interest, it also does not carry counterparty risk, and in times of global stress, it has historically served as a neutral reserve asset. But this move is not just about defense. It may also be about preparation. China's economy is undergoing a difficult transition. Growth has slowed. The key property sector is deeply indebted, and demographic trends are turning negative. In such an environment, liquidity becomes crucial. Treasuries are liquid, but selling them during market stress can be destabilizing. By gradually reducing exposure over time, even at a loss, China may be prioritizing flexibility over yield. Think of it like selling a house at a discount because you know you might need cash quickly later. The loss hurts, but being trapped hurts more. From the US perspective, China's exit raises uncomfortable questions. For years, foreign demand helped keep us borrowing costs low. As China and other major holders reduce their treasury purchases, the US government must rely more heavily on domestic buyers or the Federal Reserve. That can push yields higher, increasing interest costs on the national debt, which now exceeds $34 trillion. Higher debt servicing costs crowd out other spending and add pressure to already strained fiscal dynamics. While China is no longer the largest holder of treasuries, its actions signal a broader trend of diversification among global reserve managers. This is where the story connects directly to ordinary investors. When the largest players in the world quietly change their behavior, markets eventually feel it. Bond yields influence everything from mortgage rates to stock valuations. A sustained shift away from US debt by foreign holders could mean structurally higher rates, more volatility, and a weaker dollar over time. None of this happens overnight. Financial systems move slowly until they don't. History is full of examples where confidence eroded gradually, and then suddenly. It's also important to separate symbolism from scale. $688 billion is still an enormous amount. China remains a major creditor, and US Treasuries remain deeply liquid. This is not an imminent collapse story, it is a transition story. A signal that the post-2008 era of unquestioned dollar dominance and endless foreign demand for US debt is evolving. Countries are reassessing what safety really means in a world where finance and geopolitics are inseparable. So when you hear that China sold US debt at a record loss, the key insight is not the loss itself, but the willingness to accept it. Losses are usually avoided unless the alternative is perceived as worse. That tells us something fundamental has changed in how Beijing views risk, power, and the future of the global monetary system. And once that perception shifts at the top, it tends to ripple outward in ways that take years to fully understand, but only moments to feel in markets when the pressure finally arrives. And that brings us to what this exit really signals for the dollar, precious metals, and global capital flows right now. Now the real implications start to come into focus because China's decision doesn't exist in isolation. It sits inside a much larger shift in how money, power, and trust move around the world. When a major holder like China reduces exposure to US debt, markets don't just look at the transaction, they look at the message. And the message is subtle but powerful. The old assumptions may no longer be reliable. For decades, the global system was built on the idea that surplus countries would recycle dollars back into US assets indefinitely. That circular flow kept borrowing cheap, asset prices high, and volatility relatively contained. But once that loop begins to weaken, even slightly, the entire system has to adjust. One of the first places this adjustment shows up is in bond yields. Think of the Treasury market like a massive auction that never ends. The US government constantly issues new debt to fund deficits, and buyers must be found every time. If one group of buyers steps back, others must step in, but they usually demand a higher return. That is why analysts pay close attention not just to interest rate policy, but to who is actually buying the bonds. Over the last few years, data has shown foreign official demand cooling, while domestic institutions and the Federal Reserve take on a larger role. This shift matters because domestic buyers are more price sensitive. They will not buy at any yield simply for strategic reasons. They want compensation for inflation, risk, and opportunity cost. Inflation itself plays a central role in this story. When inflation surged to multi-decade highs, it shattered the idea that treasuries always preserve purchasing power. Even if you get paid back in full, if those dollars buy significantly less, you still lose in real terms. China, like other reserve holders, looks at real returns, not just nominal ones. During periods when US inflation runs hotter than treasury yields, holding bonds becomes a guaranteed loss after inflation. From that perspective, selling treasuries at a nominal loss can actually be a rational choice if the expected real losses from holding are even greater. It's like choosing to take a hit today instead of a bigger hit tomorrow. This is also where precious metals re-enter the conversation in a serious way. Central banks don't buy gold because it's fashionable. They buy it because it behaves differently from paper assets. Gold tends to perform well when trust in currencies weakens or when real interest rates fall. Over the past few years, central bank gold purchases have reached levels not seen in decades, with China consistently among the top buyers. This doesn't mean China is abandoning the dollar tomorrow. It means it is rebalancing toward assets that sit outside the dollar system entirely. For individual investors, this is a clue. When the biggest, most conservative players diversify, it's usually not about chasing returns, it's about managing risk across decades, not quarters. Anoth. Angle that often gets overlooked is trade settlement. China has been pushing to settle more international trade in yuan rather than dollars, especially with energy exporters and emerging market partners. While the dollar still dominates global trade, even small shifts can reduce the need to hold massive dollar reserves. If you don't need as many dollars to pay for imports, you don't need to hold as many treasuries. This feedback loop slowly erodes structural demand for US debt. Again, this is not a dramatic overnight change, it's a slow grind that only becomes obvious in hindsight. There is also a psychological element at play. Markets run on confidence as much as fundamentals. When investors see headlines about record losses and massive exits, they begin to ask whether they should reconsider their own assumptions. That doesn't mean panic selling, but it does mean reassessment. Portfolio managers start to question duration risk, currency exposure, and diversification. Over time, these small adjustments can add up to meaningful shifts in capital flows. This is how big changes happen quietly, until suddenly they are no longer quiet. Critics often argue that China's selling treasuries is irrelevant because someone else will always buy them. And to an extent, that's true. The US Treasury market is deep and liquid, and there is no immediate shortage of buyers. But liquidity does not equal immunity. The price at which buyers are willing to step in matters. Higher yields may act buyers, but they also increase borrowing costs across the economy. This feeds into housing, corporate debt, and equity valuations. In other words, even if the system absorbs the supply, it does so at a cost.